Welcome to the Retirement Answer Man Show. My name is Roger Whitney, and I am here with Andy Panko. This is the show
Hello.
dedicated to helping you not just survive retirement, but rock retirement. Andy, are you ready for tax management in retirement this year?
Yes, let's rock it.
Actually, it's not this year. It's this entire month on the Retirement Answer Man podcast. Now, if you're listening to this podcast like you normally do, realize that we're actually recording this as a video episode that will be on our YouTube channel, youtube.com/Retirement Answer Man. So it's a little different vibe for myself and for Andy. We actually have to look presentable. So if we sound a little bit clunky, that's what's going on. You're a pro at this video stuff, though, Andy, right?
That's giving me way too much credit. I've done some videos. Let's say that. Yes.
You're comfortable with videos, right? You're comfortable with whatever happens.
I am. Yes. There's a humility in videos that I think is interesting to watch. As long as the content and message gets across, don't be too concerned about the rest of the stuff that's going on in the video.
There you go. So I want to set the stage for a little bit because we have a lot of changes even with the podcast, not just the video. And this month, we're going to have actually 2 podcasts a week. So this is going to feel a little bit different. Today, Andy and I are going to talk about this is the first installment of the main theme for this month, which is tax management in retirement. And then you're going to get another podcast that will not be video, by the way. So if you're watching on YouTube, you can subscribe to the podcast on your favorite podcast player, where we're just going to focus on listener questions. So we're going to have 2 episodes a month, one of them being video. And so the theme for this month is tax management in retirement. And we're going to cover this in 4 installments. Today, we're going to talk about why it's important and sort of understanding the tax code. Fun. And then next week, we're going to start off with identifying the landmines, the hidden tax bombs that can blow up in your retirement. And then after that, we're going to talk about the tax toolbox. And then the last episode, how do we integrate tax planning into your retirement plan, which is, Andy will probably agree, extremely important. So today we're just going to talk about why this is so important. So Andy, obviously the reason you're on is, one, you're an awesome guy.
Thank you.
Yeah, and a retirement planner that really focuses on the tax aspect of it. So what changes come about that we need to be aware of?
So obviously there is the regular income tax people are generally aware of. Not just when you're working, you have wages, that's all taxable, but when you retire, it's the distributions you take from accounts, specifically those that were tax deferred, your 401k, your 403b, your IRA, those things that as you contributed to throughout your working years felt great because you were getting a tax deduction at the time for the monies you put in. Well, it wasn't really a tax deduction. It was just a tax deferral. You still have to pay tax at some point. You just kick the tax can down the road. Now, in retirement, when you start to pull that money out, those distributions are generally taxed. So you have that, which people, I think, more or less understand. But there's other retiree-specific things that come into play that you never had to worry about before, like Social Security, how it's taxed. Even Medicare has some tax angles to it to try to avoid if possible, and a few other things that may sneak up on retirees. Another big one is often ACA health insurance. If you are using that to bridge your health insurance needs from when you stopped employer coverage to when you turn 65 and can start Medicare, there's potentially very, very substantial tax credits / subsidies you can get on those premiums if you can manage to keep your income below certain levels. So that's another sort of tax thing that's often unique or common to retirees.
So essentially the game changes from your working years, right? You go from accumulating assets, and the general premise of tax planning has been defer, hasn't it?
Right.
And now you have more of an ability. Like a good example is, we have this new proposed tax changes, and you and I in our working years we're strapped to the raft going down the rapids, and we really have no opportunity to change the situation. We're just going to have to ride it out, maybe tweak it, because we're not going to stop earning our income, right?
Right. Mm-hmm.
In retirement, that changes, though, doesn't it? You have a lever that you didn't really have before.
Exactly. You nailed it. So during your working years, your income kind of is what it is. You know, your wages are what they are. You can't make them go away. You don't want them to go away. You know, maybe you bit that dangling carrot of defer by putting it into your, you know, employee retirement plan or IRA or whatever. Maybe you have some bank interest, maybe some dividends and capital gains from investable activity. But otherwise, you know, your income is what it is without much control. In retirement, you could potentially have a lot of control over your sources of income and the taxability of those sources of income. So there are, for better or worse, you know, potentially a lot of planning opportunities around to how to get your retirement income in the most tax efficient way possible, which is good, but that also makes it potentially complicated and difficult for people who haven't thought about these things or aren't, you know, well versed in the angles to be aware of. And it can be overwhelming, but nonetheless, there are opportunities to be had.
It's really just a muscle that we haven't used, right? Anytime you try a new exercise in the gym, Andy just went to a wedding, so anytime you get on the dance floor, if you haven't done it in a while, it's a little awkward at first. You're not quite sure what to do, but practice makes perfect, so a lot of it is just figuring out, well, how do I think differently now that I can control, to some extent, how I realize income, right?
Right. And I guess it could be a blessing and a curse.
Reference in, didn't you?
Yeah, he did. So, you know, for those watching at home, I am not good at dancing. I try to avoid dancing at all costs. And I was at a wedding recently, which, as everyone knows, are big dancing events. And I'm that guy trying to find any excuse possible to not be too close to the dance floor and not have my wife drag me onto said dance floor. So it's interesting times for me at weddings. I'm real good at taking the photo booth pictures, though, for what it's worth. So there's that.
There you go. You got the face. You got the face for it.
I try.
And so since we have all these levers, unlike in the accumulation, you know, I can think of CPA conversations I've had. Okay, Roger, if you do this, this, and this, you're going to save this much this year. That was essentially the conversation. Right. Okay. So I got to make that HSA contribution and I'm going to save this much in taxes. It was literally, you realize the benefit right away. In retirement, that can be actually detrimental potentially, just thinking in 1 year increments, right?
Right. That is another big difference. And this is part of the difficulty in doing longer term tax planning, tax projections. When it's year by year and the typical tax return preparer will focus on and hang their value on how low can I get your tax bill this year? Let's find ways to defer, like 401k contributions, you know, HSA contributions and whatever other deductions and exclusions you have available to you. But that could be a short-sighted view, saving the few $1,000s in taxes this year to just defer it down the road to who knows what your income and your tax situation may look like 10, 20, 30 years in the future. That could come back to bite you. And in a lot of people, for better or worse, sort of, I don't want to say fall for that trap, it makes it sound bad, but have pumped most of their savings into these tax-deferred vehicles throughout most of their life. And yes, got the little tax break along the way. And then they get to retirement and realize, wow, I have a lot of tax-deferred income that I'm going to need to pull and may not have a lot of options around it because all my money, for the most part, is in this big, fat tax-deferred bucket. I don't have a lot of control over the taxability of it. I'm going to have to take it and realize the taxes, especially if tax rates increase, which logical to think they will. You have that as well. And then layer in these other sort of retiree-specific things I mentioned, like Medicare premium surcharges, like how Social Security is taxed. And this can all add up to, guess what? You may actually be in a worse tax situation in retirement than you were in your working years. So the traditional logic of do the deferral while you're working, because it would, you know, you would think that those are your highest earning years, therefore your taxes should only be lower in the future. Well, that's not always the case.
And even, you know, the traditional, like if you use an online retirement planner, and this is true for, the planners you and I use, the default is you drain your after-tax assets first before you go to your tax deferral assets, and that tax deferral all the time. And in retirement, because you're so close to harvest and you have this age 72 coming up, if you drain all your after-tax assets when you have no income, so let's say you make 20, 30 grand a year off of just stuff, and then you're just draining your after-tax assets, you're in a low tax bracket and you're building this big tax liability because in theory, your IRA is still growing, and then you're going to be forced to take money out later on. A good example is I have a client that I've worked with for years who is a doctor, so they were very sensitive to the asset protection part of it. And all they have are IRA assets. And now he's about 80 now, and they've been taking more money than they need, a lot more than they need, in required minimum distributions, and they got to pay tax on it. And so it's like an annual conversation of, whereas if they had used some levers early on, the total tax of their life would have been a lot different, right?
Sure. Yeah. And that's one of the good opportunities for retirees, specifically those in the fairly early stages of retirement where they may not have yet started Social Security, are not yet of RMD age, but their wages stopped. Starting the year, you may have little to zero taxable income. Now that may feel good, like, wow, I can get away paying no tax or close to it. But if you have this large tax deferred bucket of assets still, not pulling some of that out is a missed opportunity. Like at a minimum, pull out enough to what we call fill up your lower tax brackets. Pull out enough to fill up your 10%, 12% federal tax bracket. Maybe even go into the next one, currently 22%, depending how big that that tax deferred nest egg is. But this is where you have that ability to exercise some control over the taxability of it. Instead of just letting that tax deferral snowball forever and be forced upon you when you're 72, take some out now while you can do it in relatively low tax brackets to help get ahead of some of that future tax burden.
And so the goal of this whole series is and we're just setting the stage here. The goal is, like next week, we're going to talk about these tax bombs, these ACA subsidies, IRMA, and other things. And then we'll talk about the toolbox you have of filling up the tax brackets or the tax buckets, as you said, Andy. I think of this as it can get overly complicated very quickly. And so I do think we need to give ourselves some grace here. I always tell clients, we're not going to get this right. We're just going to try to think about things in an organized way so we don't just miss an opportunity because of ignorance or inattention, right?
Right. And taxes are, I should step back. Taxes are definitely important, but they shouldn't be the end all be all. Taxes are important in that it's not what you get, it's what you keep that matters, or not what you make, but what you keep that matters. The more that you can trim Uncle Sam's bite of your stuff, the more you get to keep, which is important. Now, as you said, Roger, this can get very complicated, very technical, very overwhelming, because there's not always going to be a definitive, clear, or right answer. Hindsight will be 20/20. We'll know after the fact what the best answer would have been, but we don't have that. So don't stress too much about this. Having to pay taxes in some sick, twisted sense is a good thing because it means you have a lot or you made a lot. But that doesn't mean you should pay more than you need to. And that's where you and I come in to help try to minimize that. But yeah, it's as easy as it is to get overwhelmed. Try not to let that happen. Good tax planning and tax efficiency could make a good plan better, but it's not going to make or break a retirement, right? The big, more important things are getting your asset allocation right, getting your spending under control relative to your financial resources. Getting those wrong can sink you. Getting your tax strategy, tax planning wrong will not sink you, right? It may make things slightly worse off, but it's not going to destroy an otherwise good plan.
Yeah, in the agile process, we think of this as stage 3 optimization, right? Of how you shore up risks and take advantage of opportunities.
Exactly. That's a good way to put it.
Yeah, it's funny. We're going to talk about the tax bombs next week, but the tax code, especially in retirement, but I'm sure it's that way. I haven't noticed it as much as I'm working. I think of it, it's becoming more like our cell phone bill. You have the tax bill, but then you have all these surcharges, trunk fees, whatever. And the things we're going to talk about next week are all these little charges that can add up to a lot of money. And then, one area where I have recently found that it's gotten complicated is you may choose to realize more tax early in order to accomplish a different goal. So as an example, recently I had a client with a very large concentrated position in retirement. It was a good portion of their net worth, and we chose to pay the long-term capital gains in order to diversify and build their income floor to pay for their life. But as a result of that, with the ACA, which is the Affordable Care Act, we'll get into that next week, they had to forego subsidies that they might have had they not sold the stock. So
Sure.
their medical premiums went up significantly by doing this, but it accomplished a larger goal, in this case, trying to diversify a little bit.
Yeah.
It's complicated.
It really is. I just got off a call with someone and had a conversation around the same thing. Lots of highly appreciated securities in a regular brokerage account that they want to liquidate and monetize to build up cash for their next few years of expenses in early retirement. And the question was, well, I don't know what to sell. Everything's at a gain. I'm going to have to pay the tax on it. And yes, that is the answer. Maybe you just have to bite the bullet, pay the capital gains tax. But you can accomplish other things in the process. Like, what if you have an outsized position in a single stock or otherwise some relatively high risk investment? Well, getting rid of that not only frees you up some cash, but can help better diversify you and prevent a potential meltdown of that single name dragging down your whole portfolio. That could have a very bad impact on your long-term financial projections. So you have to weigh all these.
It's hard to conceptualize that, though, isn't it? Because it hasn't happened yet, and it might not happen.
It is. And that's the big difficulty with all this, is there's a lot of educated guessing, frankly, which I know people aren't comfortable hearing. They rightfully so want to see some report that says, this is what I should do, convert this much this year, pull out this much this year, for the next handful of years. And that's what we try to do. But you have to realize we're making guesses about, I say guesses, but educated guesses and statistically relevant predictions about things like financial market returns, inflation, your own longevity, your own life circumstances, meaning your income, and maybe you go back to work because you get terribly bored. So now you plan on not working.
Marital status, which changes, right?
Marital status, tax legislation. No one knows what's going to happen there. Any one of these things could have a very real impact on these projections, such that it can prove the projections wrong after the fact. So don't get too hung up on wanting or needing to see a report that says, I should do X, Y, Z right now for the next X amount of years, because the plan will be wrong. The plan will change. It doesn't mean you don't try to project and do what you think makes the most sense now. But stealing one of your terms, Roger, you need to stay agile. Even in retirement, all this stuff will be a moving target.
Yeah, and I think you also need to have a framework to think in an organized way. Because generally when we're worried about tax code, as an example, where everybody's freaked out about the tax code. I'm freaked out about the tax code. But I don't know what the tax code is yet, or the changes, the proposed changes. And it's very easy when I'm freaked out about something to react, to do something that makes me feel like I have some power over it, and just think very tactically rather than thinking strategically, because what you do tactically, if you don't have an overall strategy, can actually put you in a worse position, even though it felt good in the moment. And that's a lot of what we're talking about. So this is going to be fun, Andy.
Definitely.
So let's start off. So now we've set the stage of, hey, this is really important. And we're going to try to build a framework for you to think strategically. But first, we need to do something that's very important, that it's very hard to do, is understand taxes. How do you, I read my tax return. I'm not an enrolled agent like you are, and I understand taxes, but it's still, I get fuzzy head from time to time. And I do this for a living. Let's talk about some common terms like adjusted gross income, or maybe we should even start with gross income. I'm going to let you lead this.
Sure. So the U.S. tax system is incredibly complicated, but in a nutshell, most sources of income are taxable, some are not. For example, some things are completely excluded, like life insurance proceeds. If someone were to pass and you are the beneficiary of a life insurance payout on that person, and let's just assume it's $1 million, that $1 million in no way hits your tax return. It is completely excluded from income, if you will, from a tax perspective. Outside of that and a few other things, basically all forms of income, most forms of income are taxable to you on your tax return. And it's important to understand your tax return. Even if you don't do it, it'd be very helpful to read through it and sort of follow along here. So you add up your sources of income: dividends, interest, Social Security, pensions, wages, capital gains. So if you were to sell a security in a brokerage account at a gain, that's part of your taxable, your gross income. So you add all those things up, that's your gross income. Against that, there's a few things you can deduct or adjust. Like if you had an IRA contribution, you could potentially deduct that. A contribution to a HSA, health savings account, you can deduct that. There's about a dozen things: student loan interest, certain business expenses, self-employment taxes. I'll stop there, but those things help reduce your income. You net those all together, and that's your adjusted gross income. That's an important term. A lot of things that we're going to talk about throughout this month are keyed off of your adjusted gross income. So definitely know what that is on your tax return. I think it's line 11 on the 2020 tax return. I could be wrong, give or take a line, but that's where you'll find it.
You just gave me a great idea, and I was writing it down in the Rock Retirement Club, where we have live meetups with members. I think it'd be awesome if we did a walkthrough of a tax return to
I would love
look
to.
at the different lines and understand it from a basic level, because you described it in a very basic way, right? You basically have income and you have these things that can offset it, and that gets you to line 11 or one above or below. That's your adjusted gross income. And then what types, and then the next part, if you know your adjusted gross income, I would assume would be what things use AGI to add the surcharge or not. So are you aware of any?
Yeah. Oh, painfully aware. So there are, you may have heard a term called MAGI or MAGI, I call it. Some people say MAGI, whatever, but it stands for Modified Adjusted Gross Income. Now,
we go there next, for sure.
Yep. There's not a single definition of that. There's about a dozen that I'm aware of. They all start with your AGI and then add or subtract certain line items to or from it to arrive at your MAGI, or Modified Adjusted Gross Income. So, for example, the definition of MAGI that is used to figure out whether or not you owe additional Medicare premium surcharges, that definition of MAGI is simply your adjusted gross income plus any tax-exempt interest you had, like interest you earned on a municipal bond, for example. That interest is not taxable, but it's included in MAGI for purposes of Medicare surcharges. That's one MAGI. There's a different MAGI used to determine your eligibility to deduct your IRA contributions. There's another one used to determine whether or not you can make a Roth IRA contribution. There's another one used for something called the net investment income tax, which we'll wrap about next week. So there's about a dozen I'm aware of. There's probably more, but for retirees, there's really 5 or 6 that are most likely to come into play.
So let me restate for my own understanding. So we have adjusted gross income, right? We have the income we receive from the checklist of sources.
Yes.
And then some things that offset that, IRA contributions, etc. And then we come to MAGI. It makes me think of Irma with Medicare, and they really need to have a masculine name, because Maggie, now I don't like Maggie, and now I don't like Irma. We need a man name, Mag, that I don't like. But
right.
And then so modified adjusted gross income is this mushy term that says, well, for this calculation, we're going to bring back in something that we weren't counting before in order to see if it applies. And then the things we'll get into next week, each one decides to bring back in certain items.
Yes.
So you can't just use one uniform term. Is that conceptually what we're talking about here?
That's correct. And people will often ask me, like, what's Maggie? And I'll say, well, it depends. It depends on, what tax thing you're referencing, because Maggie's different. Like I said, there is no single definition of it. The other frustrating thing is you will not see Maggie on your tax return. It's not a line item in and of itself. It's some calculation that your tax return software does, or if you do it by hand, there will be separate worksheets you fill out that calculates Maggie kind of off to the side. So you won't see it in looking at your 1040, unfortunately, which makes it that much more difficult to grasp.
Yeah, this is where it gets a little bit more complicated. And so when we talk about the tax bombs, we'll try to fit Maggie in here of which one. But I don't think we need to get into the super details, right? Because we're just trying to set the stage so you can ask the questions if you're using a planner, or you can be aware of it if you're doing your own planning so you get it right.
Exactly.
Right? Or more right. It maybe is all that we can hope for. So what I thought we could do is talk about the tax code, because it's not something people think about a lot. And I'm going to share my screen with some important numbers if that would be helpful. And by the way, we're going to have this important number worksheet in our 6-Shot Saturday email. So if you're not signed up for our email, you can go to rogerwhitney.com, and right there at the bottom, you can put your name and email address, and we send out a weekly email on Saturday with 6 quick tips, and that's where we share links to resources like this, important numbers from a tax perspective. So you can check that out. So let me share my screen, and why don't you just talk through how the tax code works so we can have a base there. Let me get my screen share. Let me know if you can see it okay. Oh, there we go.
There we go.
Beautiful, isn't it?
It is. I like it.
So let's start with the federal income tax code and how this actually works in terms of what percentage you pay.
Sure. So the federal income tax it's a series of marginal rates. What that means is your first X amount of dollars is taxed at 1%. Is taxed at a given percentage. The next block of dollars is taxed at a different percentage, the next block, etc. So for 2021, for example, if you are married and file a joint return, your taxable income between $0 and $19,900 is all taxed at 10%. Your next dollars of taxable income, so from $19,901 up to $81,050, is all taxed at 12%. And then the next block beyond that is 22, and then beyond that it's 24, 32, 35, 37. Now, one thing to keep in mind, notice I said taxable income is run through these brackets and these rates. So just stepping back to the tax return concept, we talked about gross income, adjusted gross income. The tax code lets you deduct from that some deductions. There's what's called the standard deduction, which is a fixed amount that everyone can take. And then there's itemized deductions where you can cobble together your own specific deductions. And if those collectively exceed the standard deduction, then you're allowed to deduct those. But the point is, you have your AGI, you minus your deductions. That's your quote unquote taxable income. It's your taxable income that you run through these brackets and rates that Roger has up on the screen here.
And so as an example, if you're married filing joint, the standard deduction is for both of you, right? So you have 2 of them, one for each. It's about $24,000.
Yeah, for 2021, it's $25,100. There's add-ons if one or both of you are 65 or older and or blind and or disabled. But for the most part, it's $25,100.
And so in reality, and for those of you that are listening to the show, we'll be talking about this in detail. But for those of you on YouTube, so if you are, if the top of the 12% tax bracket for married filing jointly is $81,050, and if we assume you get the standard deduction, that means you can actually earn $106,950 and still be in the 12% bracket, correct? Because you get the benefit of that deduction.
Correct. 106,150. I got a calculator in front of me, but yes.
106,150. Okay.
That's correct. Yep.
And so you want to factor that in. And this goes back to your point that we'll talk about, I think, in episode 3 of this series of filling up the tax bracket. So as an example, if you have $50,000 in income from various sources, in a year in retirement, you can actually earn roughly another $56,000 more, assuming you get the standard deduction, and only pay 12% on it.
Great point. And that's what I referenced before. I do have some clients, married couple, let's say, where they only had $20,000 of income from some dividends or something. And they said, great, my tax bill's my tax bill's actually zero because my standard deduction more than offsets that. And I said, well, you got a sizable amount of tax deferred assets. Don't let these low tax brackets go to waste. Pull out, $106,000 roughly of distributions from your IRA to fill up that 10 and 12% tax bracket, as opposed to just waiting and being forced to take it out in the future when who knows what tax rates will be.
Yeah, you don't know what tax rates are going to be. And then if you don't take it out, say from an IRA or a 401k, it's going to continue to accrue and potentially grow,
right,
which will increase the amount that you'll be forced to take out. I go back to my client who they're forced to take out so much that they end up going into the 22% bracket in current tax code. Right. Whereas if they had done this when they were younger, they would have been able to avoid that. That's part of this multi-year planning that we're talking about, right?
Definitely. Yeah. Looking forward, getting ahead of RMDs. RMD stands for required minimum distributions, which is just simply under current legislation, once in the year you turn 72, you need to start taking money out of your tax deferred accounts. And then every year thereafter, you need to take out a little more. The government won't let you defer this tax forever. It wants its piece eventually. As of now, it makes you start taking it at 72 and they get their tax cut on it. So consciously pulling some of that forward in your late 50s, 60s could make sense over the long term. Yes, you're paying a little more tax now than you otherwise would have, but the goal is you're hopefully ultimately saving more than that over the long run.
Well, I think this was a great primer on taxes. And, when we think of retirement planning, we always think tactically. What am I worried about or excited about? And I move there. And this is why in my world, we have an agile process where you need to have a process that leads to an overarching strategy so you can identify the levers that make the most sense for you. But if you don't do those foundational things, it's easy to get whipshawed on the dance floor. Go back to Andy's.
Man, no, stop with the dance references. I'm getting anxious and starting to sweat.
So next week, we're going to talk about some of these retirement tax bombs, these line items on your cell phone bill that are very annoying if they pop up. But for now, let's go set a smart sprint. All right, now we're off to set a little baby step you can take in the next 7 days to not just rock retirement, but rock life. This is going to be a fun one. My challenges to you for the next 7 days is pull out your tax return and go look down and find your adjusted gross income so you have an understanding. And just look at that first page. It's all on one page, right, Andy? We don't need to go all through the other ones, right?
That's correct. It's on the first page. Yep.
And it may feel foreign to you, but that's going to help you understand some of what Andy and I have been talking about today. And then go have a drink or something and unwind after you look at that number. All right, Andy, this is the end of the first episode of Tax Planning and Retirement Basics. I think it went pretty well, screen share wise. It worked.
Super
I didn't
fun.
pick my nose at all. I was very conscious of that.
Good.
Yeah. No, I did want to tell you you have something in your tooth, by the way. I wouldn't want to tell you during the show, but
that's my pet broccoli. I leave it there.
Yeah. Anyway, welcome if you're new on YouTube with us, and for those that you listen to the podcast, it's always an honor to walk a little bit of life with you. Remember, by the way, that this is helpful hints and education. We don't give any advice, mainly because we don't know you, and if we don't know you, we're not going to give you any advice. So make sure you talk to the appropriate expert before you do anything. And with that, we will see you and talk to you next week. Bye.